Warren Buffett, George Soros, Carl Icahn, chances are you know the names of the people who top the world's best list of investors. But you might not know that plenty of regular people whose names you've never heard of have invested so successfully that they were able to retire early, devote their lives to their passions, and live comfortably off the returns of a well-managed portfolio. In this video, you'll learn the 4 most important investing rules from one of the best stock market investing books of all time, Free Capital: How 12 Private Investors Made Millions in the Stock Market. And if you stick around to the end of this video, I'll share the secret to finding highly profitable companies that 99% of professional investors miss, even if you're a complete beginner. So watch this video to the end, and let's get started. Expect and value mistakes. Investing experts usually agree that it can take anywhere from 1 to 5 years to learn how to invest wisely. Want to speed that process up? Make mistakes. Okay, not on purpose, but understand that investing is hard and you will make mistakes. If anyone could begin making massive returns their first time investing, everyone would jump into investing, and as a result, once again, very few people will rise to the top and get rich. Even the greatest investors learned by trying, failing, and applying the lessons learned from their losses to make them better. The 12 investors featured in Guy Thomas's book are living proof. They are all what would be considered average, ordinary people who wanted financial freedom and found it through learning to invest in the stock market. They didn't have billionaire mentors or generational wealth to sit back and watch grow. They got their hands dirty, made a lot of mistakes, and eventually got good at growing their money. If you want to become the best investor you can be as quickly as possible, focus on learning, not returns. It may seem counterintuitive, but there's a reason. Mistakes you make early on in your investing career, while your portfolio is smaller, will have much less impact than later on when a loss can mean hundreds of thousands of dollars. As the guru investor dubbed Vernon in the book says, success in investing consists mainly of avoiding big mistakes. And the best way to avoid big mistakes is by making them while they are still small mistakes. If you can begin your investing journey by expecting and valuing mistakes, you'll set yourself up for a long, happy relationship with the market. Shrink the investing universe. You've probably heard the standard investing advice that 20 to 30 stocks is the ideal range for most portfolios. But the investors featured in Free Capital average closer to 10. Instead of trying to touch every corner of the market to reduce volatility in your portfolio, you can stack a handful of stocks that are likely to overperform the general market. A common theme throughout Free Capital is the opportunity cost associated with each asset you add to your portfolio. If you can achieve similar results while spending far less time and energy researching industries, tracking metrics, and learning about individual companies, why wouldn't you? You don't have to dip your toe in every industry to be a successful investor, but beginning investors should make sure their portfolio isn't too concentrated. Obsessively watching the performance of 1 or 2 stocks can quickly turn emotional, which is the worst enemy of a savvy investor. Likewise, when selecting stocks, don't try to see the entire picture of any one company. Stick to a few key metrics, or you'll get lost in the sauce of information and assign too much value to things that don't matter that much. Find what trends and figures feel the most important to you, like price to earnings and debt to equity ratios, and don't worry about the rest. Make it personal. Learning which metrics are most important to you is just one part of developing an investment strategy. It can be tempting to blindly follow the strategy of a successful investor and hope you experience the same returns, but that rarely works. Much like trying to replicate someone's style by buying the same closet. It won't fit right. You bring your own background, preferences, and personality with you. And trying to follow an investment strategy that doesn't mesh with who you are isn't sustainable or wise. So this is one of the few times in the investing world where the phrase "be yourself" is actually kind of useful. Chances are you'll try on a bunch of different approaches and methods before you find one that works for you. Maybe you have a professional background that makes you an expert in an industry, and you decide to focus more individual attention on stocks in that sector, while leaving the rest to a good index fund. Or maybe you have the kind of personality where you get bored easily, so you decide to use a small percentage of your portfolio exclusively for investing in your current fixation. The investment strategy that keeps you on track for reaching your ultimate goal of freedom is the right one for you, even if Warren Buffett would hate it. Know your why. There's a false narrative among poor people that consumption equals wealth, but that simply isn't true. Just because you bought a new Mercedes doesn't mean you can afford it. Suppose your goal is to build the kind of wealth that allows you to, say, retire in middle age and live off the returns of your portfolio. In that case, consumption will actively work against your most important priority. Let's say you withdraw $70,000 from your portfolio to buy a brand new sports car. Sure, your new ride looks good, and it might feel like you've reached a goal because you were able to buy it. Still, in reality, all you've done is eliminate $70,000 from your portfolio plus all the interest it would have earned over its time in the market. On the flip side, if you hold back on spending all the time and let your investment pot grow, the magic of compound interest kicks in. Your money starts making more money, and that's how you speed up the journey to early retirement and financial freedom. Each withdrawal like this interrupts the compounding of interest, putting you further away from your ultimate goal of freedom. The good news is that if you can curb your consumption now, your portfolio growth will allow you to do a lot of consumption later on. Things that benefit the now version of you will most likely have your future self shaking their fist. So when you see the guy driving the new Porsche, know that chances are he will be counting quarters later on while you're spending the second half of your life doing exactly what you want. Good things don't always come to those who wait, but bad things usually come to those who are impatient. You don't have to be born a Bezos or win an internship at Goldman Sachs to reach financial freedom early in life. Expect and value mistakes when you begin investing to avoid costly ones down the road. Shrink the investing universe by working with a small portfolio and fewer metrics to protect your most valuable asset, time. Find an investment strategy that works for you, and don't be afraid to let go of one that is no longer serving you as you learn and grow. Know your why to avoid the mistake of overconsumption in the short term, by staying focused on your ultimate goal of financial freedom. Following these simple strategies can help you retire earlier than most people and live a life of comfort and convenience. But if you want to speed up the process and make life-changing money in, say, 20 years instead of 50, I have good news. I recently discovered an amazing service for complete beginners to get outsized returns in the stock market without having to spend hundreds of hours doing research while keeping risk to a minimum. And as a thank you for watching until the end, I'll even throw in a free gift. So click the link in the description and I'll send it over right away.